Right, good morning, everybody. It looks like we've got most people into the Zoom room now, so we'll make a start. So good morning and welcome to this morning's Preparing for Higher Taxes CPD session brought to you by the K3 Hub. For those who haven't virtually met me before, my name's Marie and I'm a Managing Director here at Quantuma. And on behalf of our parent company, the K3 Capital Group, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2020, over 2,300 like-minded members across the country have joined our network, through which they can access a range of CPD and training sessions, not dissimilar to today's session, and also referral fees for certain types of work referred into the group. Moving on to our main event today very quickly. I'm very pleased to be able to welcome back what is a very familiar face to me and to the team at Quantuma and also at K3 Hub, Jeremy Mindell, who is today's speaker. Jeremy has been lecturing in tax for over 20 years. He's an accomplished speaker and covers issues relating to tax, pensions, share schemes and remuneration. He's also one of a very few individuals in the country who is a qualified chartered tax advisor and also holds a certificate from the CIPD. In today's session, Jeremy will be covering the September mini budget, subsequent announcements and their consequences, and I'm sure that we will all know there's been many of them over the last few weeks. Corporation taxes, draft legislation in the Finance Bill 2023, tax reliefs increasing in scope and reducing in scope, and compliance challenges. We'll also look at the tax planning areas you should be discussing with your clients before the end of the tax year. Just a few pieces of housekeeping as usual before we get going. So I can see there's a few questions coming already. So just to cover them off, take them off one at a time. So we are going to run a poll this morning. 3 quick fire questions at various points throughout the this morning's session. It'd be great to sort of get your views, and I'm sure that Jeremy will sort of look forward to seeing those responses. We are recording today's session and it will be placed on the K3 Hub website next week for those who want to refer back. We will be having a few convenience breaks on each of the hours this morning, so you get a little bit of respite. Q&A function is open, so please do feel to ask questions as you go along. Depending on the nature of the questions, I'd checked with Jeremy earlier on. Depending on the nature of the questions, it may be that he'll respond to them then and there. It may be that some of them need a bit more of a considered response, in which case we'll hold them. Jeremy will give them some thought over the break and then respond to them following. If you could just give your questions some context, just in case we need to come back to them later, that would be brilliant. We do have a presentation today. We are going to put that in the chat if the team haven't done it already, and we'll put that in the chat a couple of times throughout today's session for those who may join us a bit later. For those who may be in the southeast, Jeremy is actually going to be speaking at a Quantuma budget briefing in Slough on the morning of the 24th of this month. If you'd like to join us, you'd be very welcome. Do let us know via the chat if that's the case, and we can send you some more details about that session under separate cover. And very finally, from me, our final CPD session of 2020, unbelievably, is on Friday, the 2nd of December, where we will again welcome back Jeremy, who will be covering tax for non-tax specialists, and we'll be in touch with more details about how to register for that event in the coming weeks. Other than that, that's done for me. Thank you very much for joining us, and over to you, Jeremy.
Thank you very much indeed. Good morning. Thank you, Marie, for that introduction. Preparing for higher taxes. So at one point, we had this session and we were pretty certain that taxes were going up. And then there was the mini budget and, well, the election of Liz Truss as Conservative Party leader and then Prime Minister. And she was promising reductions in taxes. And 23rd of September, we saw the fiscal event. It wasn't called a budget because they didn't want to have the forecast from the Office for Budget Responsibility or all the other elements that go with a budget. That, of course, did not last very long. A bit like China in your hands, it sort of cracked and sort of disappeared very quickly. And indeed, I was looking that the Bank of England said yesterday that 2/3 of the fiscal effect of the mini budget had already been reversed, and we wait to see on the 17th of November what will take place with Jeremy Hunt, who has been Chancellor now for about, I don't know, 4 or 5 weeks. So a time of some turmoil, but I think that the end result of it is that we are expecting higher taxes, some spending cuts, and the reasons for that are probably manifold. But I think what we are looking at here is, large unfunded tax cuts. Market was spooked, a number of U-turns on that basis, tax rises planned, and tax cuts reversed. And that's really the background. If you had seen the sort of leadership contest over the summer, or participated in any way, seen any of the hustings, you'll have seen Liz Truss in favour of substantial supply-side tax cuts. Rishi Sunak, unsurprisingly, as the Chancellor until, what was it, June, July, until June, defending his policies of fiscal consolidation. And of course, as Prime Minister, he will carry on with those policies, having possibly on an "I told you so" basis. So I think that what we're looking at is, at the moment, a series of announcements, what I would call rolling the pitch for the 17th of November budget. And before every budget, and I think it's extremely clear that this was one of the problems with the 23rd of September announcement, was partly because, of course, the nation was in mourning for the previous 10 days after the death of the Queen. There had been no announcements, no leaks, no rolling the pitch, nothing of that sort had taken place. And therefore, the budget was a bit of a surprise. And therefore, on that basis, the absence of rolling the pitch, I think, was one of the contributory factors to why those announcements went down so badly in the market and elsewhere. Here, what you're seeing is a number of hints about what will happen in the November budget. I think it's, as I say, fairly certain that there will be some form of fiscal consolidation, reducing the gap between what the country raises in taxes and what is spent. A number of ideas are coming up in terms of expenditure cuts, some of which will go ahead, but obviously others won't. And if you paint a really bad picture now, and it's not so bad on the 17th of November, then people tend to go, phew, it could have been a lot worse. And that's the normal reaction that a government wants when it's actually raising taxes. Obviously, there is, as I say, this game of expectation management, but that adds to the uncertainty. Lots of things are floated around. A good number of them won't happen. So I recall one previous budget, there were about 10 rumors going round about sources have told me what will happen in the budget, and only 3 of the bad things happened out of 10. So important to look at that. In terms of the fact that we know that the top rate of tax will remain at 45%, that there will be a freezing of the personal allowances due to carry on until 2026. We know that the income tax cut due for April of 2023 to 19% won't go ahead. I think it's fair to say that we are looking at a situation where tax in real terms will go up. But for how long is certainly an interesting question when you've looked at previous Conservative tax raising budgets such as 1981 or 1993. They were followed pretty quickly by substantial tax cuts as the fiscal conditions consolidated. And now, of course, we are dependent on the weather. I mean, this is one of the astonishing things. I look out the window and I can see, or you can see probably just on the side, it's sunny. And every day that it is warmer, the government is actually saving money, because it's saving money on the energy price guarantee, which is, I may add, was a bigger came with a bigger bill than any of the tax cuts that accompanied that statement. So the warmer the winter, the better the government's finances. The windier the winter, the more the turbines mean that we're using less gas and less coal and less LNG, liquid nitrogen gas. So the colder the winter, the worse the economic outlook. That is the situation that we find ourselves in with the current energy crisis. What I thought I'd do is I would take, before I carry on and talk about some of the tax planning ideas, let's take the first poll. So answer which tax concerns you most. So you've got a minute or so to think about. Shall we have a look at the results? Oh, right, income tax. Nobody with international tax. Well, that's interesting. Lots of income tax, national insurance, corporation tax, unsurprisingly going up. Capital gains tax, VAT, very relatively small, and inheritance tax, also relatively small. So income tax and corporation tax looked at as the big areas of concern, and that's what I will look at in more detail as we carry on. Thank you very much. So let's have a look at some ideas, some things that you should be thinking about with clients. Well, number one, I would say, is charitable contributions. It's one of the few things where you have the choice, at least at this point, before you file your tax return, or the last due date of filing the tax return for 21-22, which is the 31st of January. You got a choice about which year to set your charitable contributions against. So unlike most other elements, you can't choose which year that you set this against. Here you can. And this is a question, again, of playing the tax rate game. Are you in a situation where your clients are between 100 and 125,140 pounds, which is, of course, the effective 60% rate of tax? Why do you get 60%? 40% normal higher rate tax, plus the 20% effective marginal rate as a result of the phase down of the personal allowance. For every £2 of extra income, you lose £1 of personal allowance. So anywhere between 100,000 and 125,140 pounds, you've effectively got a 60% rate. You've also got situations at other points in terms of the £100,000 threshold for childcare and other elements. And then, of course, you've got at £150,000 additional rate tax and losing the £500 personal savings allowance. So important to think about that. That's just one aspect. But, you know, we're coming up to Christmas. Lots of people are thinking about charitable contributions at that point. And it's an area which needs to be looked at on that basis. The next area that I think about is getting the tax return done early. Now, early is a relative term. For some of my clients, early means any time before the 30th of January is early. But the advantage of getting tax returns done early is that there is obviously less time to lose documents and more chance you're going to remember all the expenses you had as well. Other elements would be that gives you more time to plan the current tax year and the next tax year, and also consider difficult issues where you have issues over complex matters such as crypto assets or other types of income the earlier people actually do their tax returns, we're now in November, but now at the moment you've got just under 3 months to do the tax return and consider difficult issues. You also need to think about checking the accuracy of third-party information, planning the payments that need to be made. January 31st sees not only the payment of the balancing amount for 2021-22, but also the first payment on account for 22-23. And also make any elections which are required. A lot of tax elections need to be made by the 31st of January in order to make the right tax choices. ISAs, a lot of taxpayers leave it to the end of the tax year to make their ISA investments. Making them earlier in the year increases the opportunity to earn more dividends tax-free, and also to enjoy tax-free appreciation. There's also, it's £20,000, so £40,000 for a couple. And in terms of making those investments, clearly, if you do it all in one lump sum, you're not spreading your risk. So if there are major changes in the market and you're investing at a time the market is at a high, you end up with potential more investment risk rather than spreading your ISA payments over the year. In terms of pensions, this is an area where every so often the government is talked of as making changes to reduce the tax advantages of putting money into a pension, particularly for higher rate and additional rate taxpayers. Now, my belief is that I think it's unlikely that they're going to fiddle around with pensions, but you should always think about, particularly before a budget announcement, are you maximizing your contributions into a pension? And the annual allowance is still £40,000, which is deductible against your highest rate of tax. So even next year, it'll be deductible at 45%. So my advice would have been, if the 45% rate was disappearing and you're an additional rate taxpayer, to make the maximum contributions while you're getting the maximum saving. As the 45% rate is remaining the same, there isn't necessarily quite the same rush, but it's something that you certainly want to think about in terms of that area. In terms of larger earnings, remember, in terms of larger earnings, where you earn over £240,000, you would want to make a projection regarding their earnings and therefore the amount of annual allowance remaining. Remember that the phase down works that for every £2 of income above £240,000, you lose £1 of annual allowance until you reach the earnings of £312,000, where you have a level of £4,000 contributions, and that level is a floor. You will always need to be able to make £4,000 worth of contributions. To take an example, if an individual has adjusted gross income of £260,000, the AGI, then the adjusted gross income, is therefore 20,000 beyond the threshold. Divide that by 2 gives £10,000. You take £10,000 off the annual allowance and you're down to £30,000. Of course, there is also unused relief. The unused relief, you would want to look, you've got 3 years unused relief potential of £40,000 per year. And that is looked at by deducting any employer contributions, any contributions you've made, and then you take that off normally £40,000 per annum. And so if, for example, over the last 3 years, I put in £60,000 of pension contribution, I would then have potentially another £60,000 of unused relief that I can put into my pension and get a tax deduction. So important to look at the unused relief from prior years and therefore the ability to put more money into the pension, which is deductible, as I say, against your highest marginal rate of tax. In terms of tax-favoured investments, government actually announced an increase in the SCIS to £200,000. That is due to take place next year, and I'm not aware of anything reversing that. But the start of the tax year is normally a good time to consider them without feeling pressurized by the imminent end of the tax year. There are a number of offers for enterprise investment scheme investments and seed enterprise investment schemes. And why it's a good idea to consider them earlier rather than later is it's a bit like you go shopping. The best offers tend to go earlier, and what's left is the stuff which people are saying, oh, if you want the tax relief, you need to invest very quickly. If you invest in SEIS and EIS earlier, you get the advantage of potentially the pick of the bunch of investments. This is not investment advice, I should add, but there is normally a greater range of EIS and SEIS open, but also it's earlier on the clock for CGT relief. You need to hold these investments for 3 years to get CGT relief, and they need to be held for 2 years to get business property relief, i.e. relief from inheritance tax. So a number of clients invest in these areas and AIM shares as well in order for them to achieve basically IHT exempt status after 2 years, where they get 100% business property relief. And the earlier you invest, the earlier you get those reliefs. Capital gains. So at this point in the year, you might want to think about crystallizing any capital gains you have, or indeed maybe some losses which you can then use against other gains. So with some elements like shares, they can be done almost immediately. Other elements may take longer to achieve a sale. So again, capital gains tax planning is often about using up your annual exemption. This year, £12,300. There are rumours that the CGT rate will go up. I'm a bit of a skeptic on that, but it would be something that you would think about in terms of not last minute, I mean, need to make a sale on the 31st of March, but thinking about capital gains tax planning now rather than right at the end of the tax year. Other elements to think about would be residential property. We were looking at lots of gains, but suddenly the property market seems to be going into reverse on that basis. Oh, a Q&A. Can we have the slides to work with as we go through, please? Oh, that's more of a technical question. When we, on that basis, what are we looking at? Well, there's a 60-day rule. The 60-day rule is that from 60 days from the completion of the sale, not from the exchange of contracts, but the completion of the sale, you need to have done a report if there is capital gains tax to pay. That is if you're a UK resident. If you are a non-UK resident, then you have to do a 60-day report, even if there is a loss or no CGT to pay. You then have to think about all the elements you need to gather together. So that's the acquisition costs, any deemed acquisition costs, which could be the acquisition costs which are adjusted for rules such as probate value or market value evaluation. If you held the property before March 1982, then it's automatically rebased to the March 1982 value. If you're a non-resident, non-UK resident with residential property, then rebased to April 2015 values. And if you have commercial property as a non-resident, then it's April 2019. You also need to track down any capital improvement costs. as well as any disposal costs. And that's a lot of information to get within 60 days. So that would be one of the elements that you would want to think about. Other elements that I would be thinking about would be corporation tax. Let me briefly go through, because we've had now this second announcement. The original announcement was in March 2011, saying that corporation tax would go up, basically in order to repay some of the debts or reduce the fiscal deficit arising as a result of coronavirus. Then there was an announcement that this was not going ahead as of the 23rd of September announcement. And then there was a U-turn to say that this was going ahead. Now, what we think will happen is that it'll go back to the rules as announced in March 2021. In other words, the rules that were announced in March 2021 will come into effect in April 2023. So that's the thought, that the original rules that Rishi Sunak announced regarding corporation tax will come back into play. But you can't guarantee that there won't be some tweaks in the rules when the full announcement is on the 17th of November. Quick reminder, corporation tax paid by companies and unincorporated associations. Companies that are resident in the UK, you're going to pay on worldwide profits and gains. And non-resident companies with a permanent establishment in the UK, only the profits attributable to that permanent establishment. So I give the example, if you had a French vineyard and they were decided that because of climate change, they wanted to establish an operation in Kent and Sussex. If they established an operation in Kent and Sussex, they would have a permanent establishment in the UK. And on that basis, they would pay UK taxes on the profits attributable to their Kent and Sussex operations. But they'd only be subject to UK taxes on that element. The rest of the elements would be subject to just French tax as their French resident. Also, there is non-resident companies without a permanent establishment. They carry on a trade of dealing in or developing UK land. They're caught by the anti-avoidance rules, which came in 2016. And non-resident landlords now pay corporation tax rather than income tax. And those rules came in April 2020. A quick reminder of residents, and the reason that I give that is, I mean, it goes back to a very old tax case. A company resides for the purposes of income tax. That was when companies paid income tax rather than corporation tax. Where its real business is carried on, I regard that as the true rule, and the real business is carried on where the central management and control actually abides. And this, of course, has become much more difficult because of coronavirus, particularly for smaller companies. If people spend large amounts of time directing their businesses from abroad, it could be that the central management control actually goes somewhere else. And it is important to look at that. You're looking at the highest level of control distinct from place of main operations. The meeting place of board of directors is important, but not conclusive. Why is that important? Well, that's clearly a key area because, again, boards of directors have met in other places, unusual places, because of coronavirus restrictions. Now, those leniencies which HMRC and other tax authorities gave have pretty much come to an end. So therefore, again, you've got to watch for where your directors are actually discharging their duties. Just a reminder, as I say, resident companies' test of residency is where they're incorporated or where their central management control is. And on that basis, they'd be taxed on their worldwide income and profits. For non-resident companies, You look at if they have established a permanent establishment in the UK, an economic activity that generates profits, they would be taxed only on those profits. If I look at that element, here there are two elements that you think about: a fixed place of business, or if you have a dependent agent, if you set somebody up as an employee who is in another country, perhaps doing sales from their home, that could be enough to trigger the permanent establishment rule. And what you're finding is a lot more small and medium-sized companies are being caught by this. And of course, as other countries are looking for great amounts of tax revenues to deal with their own budgetary problems, they are looking more and more at companies who have some presence in their country, establishing a sales force or an agent who works for that company. That could create a permanent establishment and therefore a corporation tax liability. If we look at permanent establishments, the two areas I would draw attention to would be a place of management or a branch. And a place of management could be an employee's home if, let's say, for example, you put an employee into Denmark and they were the representative dealing with Scandinavian matters, building up a business in Scandinavia. Even though there isn't an office there, if that is the place that the person does their work for on a permanent or semi-permanent basis, that could establish a permanent establishment in Denmark with resultant tax charges. So let's look at the U-turns, the tax rates and payments. So since 2015, we've had fairly stable corporation tax rates. They dropped in 2010. They were at 28%. Under the coalition government, they dropped to 20%. They're now at 19% and have stayed there effectively since 2017. The fiscal event on the 23rd of September, of course, gave a number of announcements, some of which, of course, have been reversed. So I've had a couple of questions. Let's see if I can answer them now. If you have a limited company with 3 directors, all in different locations, you could class each as a PE and be subject to tax on that basis. And the answer is, yes, that could well be the case. It would depend what those directors are doing. But effectively, yes, you could end up with central management and control being dispersed into 3 places. You could end up with them carrying out specific functions which are economic activities generating a profit in 3 countries. That is not impossible. So, fiscal event, as I say, we can knock off the elements which have been done or not done. So, reversing the national insurance 1.25% employer, employee and self-employed. So, employee went up to 15.05%, employee went up to 13.25%, and self-employed up to 10.25%. Those are being reversed as of Sunday, and that reversal remains in place. Reversing the dividend tax rise, so dividends went up by 1.25% to 8.75% for basic raters, 33.75% for higher raters, and 39.35% for additional raters. That was going to be reversed from the end of this tax year, and that has been scrapped. The fiscal event scrapped the CT rise, but as you know, that has been reversed. They scrapped the bankers bonus tax. Easy to do a spoonerism there, which would be unfortunate, particularly as we're being recorded on that basis. double the CSOP limit to £60,000. That is still going ahead. And they said that the IR35 would go back to the responsibility of the personal service company to both determine whether they're within IR35 and also to administer the payments, reversing the 2017 and 2021 changes. And that element has now been scrapped. What's the benefit of scrapping the banker's bonus tax? It wasn't a tax, it's a cap on bankers' bonuses. So there was EU-inspired limit on how much bankers could pay themselves in bonuses. Actually, from a tax point of view, the Exchequer gets more money if bankers' bonuses are higher, because it gets 45% plus was it 2% national insurance. So that's a regulatory matter rather than a specific tax matter. So those were the highlights of the ill-fated mini budget or fiscal event. The other element was removing inherited European law, and that is still going through at the moment. On the day that I think Liz Truss resigned, that law received its second reading in the House of Commons, and more tariffs abolished. And Kemi Badenoch, who remains as Trade Minister, is looking to try and abolish tariffs nearly every day with different countries. So that will still go ahead. The U-turn, one of the major U-turns by my namesake, Jeremy Hunt. Nice to see Jeremy back in the cabinet. Friday's U-turn, 2/3 of the fiscal event was effectively reversed on that basis. And then you get measures which have been announced and not reversed, which are still there as far as we know. The annual investment allowance, allowing you 100% relief against capital expenditure on plant and machinery, at £1 million, has now been extended indefinitely beyond April 2023. The super deduction at 130% ends April 2023. The banks, we think, will still pay tax when you include the surcharge at 27%, but the surcharge allowance on the bank's super profits tax increased to 100 million, so the threshold. Believe that that is still the case. So has the reversal to IR35 been revoked as well? I think it has. I think the reversal, bringing it back to the PSC, as far as I can see, is not going to go ahead. So it'll remain with the end user. All will be clarified, I suspect, on the 17th of November. But I believe that that element, which would have cost the government, they estimated, another £2 billion, they will just not go ahead with it. And you might work on the basis. I think that it's easier not to go ahead with a tax cut, which was due, April next year. That is easier to do than to actually raise taxes mid-year. So this was a fairly obvious one, in that moving the responsibility to the end user was estimated to bring the government in an extra £2 billion. Therefore, moving it back to the PSC would have probably lost the government quite a lot of money. So it's a fairly easy element on the basis, the sound principle of you don't miss what you've never had. The other U-turn, so the big one here, is corporation tax up to 25%. As I say, the IR35 responsibility remaining with the end user for both large and medium-sized companies. And the dividend tax reduction, well, the announcement's been reversed, so dividend tax rates will be at the higher level. As I said, dividend rates at 8.75% for basic rate, 33.75% for high rate, and 39.35% for additional rate. And that will remain where it is. So if I'm thinking about it's a double whammy on dividends. One is you're paying a high rate of tax. But secondly, of course, if you have a higher rate of corporation tax at 25%, or indeed between, as I'll explain in a minute, between 50,000 and £250,000, the actual the marginal rate of corporation tax is at 26.5%. It makes paying dividends in comparison to salaries still slightly more tax efficient because you don't have to pay national insurance. But there's been, I think, a deliberate effort to narrow the difference between the fiscal difference between paying dividends and paying salary. Is the reversal of the NIC increase, health levy, still effective? Was this back on the books again? No, the reversal of the NIC rise happens on Sunday, on the 6th of November. So that is going ahead. The dividend rise, I think they've just decided, well, we can tax dividends a bit more. So I'm not at the moment, until the 17th of November, there are no plans for increasing national insurance. And the repeal of the health and social care levy has just gone through. So again, we'll have to wait until the 17th of November to see how they're going to plug the fiscal gap. Are they going to increase national insurance rates from April 2023, having just cut them, cutting them in 2 days' time? You know, that element of the fiscal event is still in place, and that effect is still there. They haven't announced a reversal on national insurance, but as I say, the dividend rise remains the same. I hope that answers the question. Confusing, I agree, but I think that they've decided that the opportunity to whack dividends by a bit more is not going to be that unpopular. So the announcement really, the big announcement from the 1st of April 2023, the CT main rate for non-ring fence profits, i.e. outside oil and gas extraction, increased to 25%. That applies to profits over £250,000. There's a small profits rate introduced for companies with profits of £50,000 or less, so they continue to pay CT at 19%. Indeed, one of Rishi Sunak's taunts to Liz Truss over the summer, or certainly, shall we say, objection to a plan, was that she was planning to give a big benefit to large companies, and he pointed out that small companies still not affected by his tax rises. The point would be that companies with profits between 50,000 and 250,000 will pay tax at the main rate, reduced by marginal relief. That provides a gradual increase in the effective rate of corporation tax. And I think that what you're looking at is a certain amount of going back to the old days of April 2015, pre-April 2015, before the main rate of corporation tax and the small companies rate were unified at 20%. You're introducing all these rules about a small profits rate, augmented profits. So if we're looking at the marginal rate, although dividends received are not generally subject to tax, so if a company A receives a dividend from company B, that is not normally taxed, subject to corporation tax, because it's already been paid out of post-CT profits. What it will do is affect your marginal rate of tax and reduce the relief that you can get. Also, the rates of 50,000 and 250,000 are reduced for the number of associated companies that you have. So if you have two companies in association, those rates reduce from 250,000 to 125,000 for the 25% rate, and from 50,000 to 25,000 is the threshold for the 19% rate. So effectively, the more associated companies you have, the higher the amount of corporation tax you pay. And therefore, one of the tax planning points is, do you actually need all these associated companies on that basis? So one of the tax planning points is, if I reduce my number of associated companies from 4 to 2, I effectively double the thresholds from effectively £12,500 to £25,000 for small companies rate tax. And again, I'll increase and double effectively my the large company threshold as well. So getting rid of associated companies who are no longer needed may be useful where your profits are below £250,000. In terms of the new small profits rate, corporation tax is charged at the standard rate, and then reduced by this marginal tax relief. But effectively, as I would explain, the paradox of that is, if you're going from all your profits being taxed at 19% of £50,000 to all of your profits being taxed at 25% when you get to £250,000, the logical point is, of course, that the advantage you have, the maximum advantage you have, is 6% of £50,000, i.e. the difference between 19% and 25% is 6%. You're getting that advantage. The maximum advantage you're getting is at £50,000. So 6% of £50,000 is £3,000. In order to get from all your profits taxed at £50,000 at 19% to all your profits taxed at 25%, so there isn't a band that remains, you actually have to tax profits at a higher rate between £50,000 and £250,000. You have to gradually erode the £3,000 of benefit you have. You take £3,000 over £200,000, that is 1.5%. So effectively, the marginal rate of tax is, for every pound you earn in profits between £50,000 and £250,000, the marginal rate of tax is 26.5%. So when you're looking at salaries versus dividends, you need to take that into account, that if your client is earning profits between £50,000 and £250,000, the marginal rate of tax is 26.5%. Also, for close investment holding companies, which include most family investment companies, they will pay 25% corporation tax from the word go, i.e. from the first pound of profit. Effectively, there is a carve out where the close investment holding companies are carrying on a trade or trades on a commercial basis, or they're making investments in land or estates, or interest in land where the land is or intended to be let commercially. So close investment holding companies do not include incorporated property businesses or trading companies. But if you have, for example, a family investment company whose main purpose is just to hold investments, they will pay 25% tax from the word go. You do need the calculation of the augmented profits. For the purposes of this part, companies' augmented profits of an accounting period are the company's taxable profits of that period, plus any exempt distributions of a qualifying kind. That would exclude 51% group dividends. They're not included in the augmented profits calculation. But you do have a situation that if you receive dividends from non-group companies and you're in the £50,000 to £250,000 tax bracket, that reduces your marginal relief, and therefore on that basis increases the effective rate of tax on your normal chargeable profits. The dividends themselves are not subject to tax, as I said, but they affect the rate of tax that all your chargeable profits are subject to. Let's take an example of marginal relief. The effective CT rate in the margin between 50,000 and 250,000 calculated as follows. Corporation tax on profits of 250,000 at 25%, 62,500. CT on profits of 50,000 at 19% would be £9,500. The difference in profits is 200,000. The difference in tax is 53,000. Therefore, CT rate in the margin, as I indicated, 53 over 200 is 26.5%. Give an example of marginal relief for the 12 months chargeable accounting period, corporation tax accounting period, to the 31st of March 2024. The taxable profits are 100,000. Dividends received is zero. The augmented profits, because the dividends received was zero, £100,000. How you calculate that is corporation tax at 25%, 25,000, less the marginal relief. The marginal relief, as I pointed out, the way it's worked out is effectively the £3,000 maximum relief for the small companies rate over the £200,000 of the transitional profits period. So you get 3/200, and what you look at is the difference between my taxable profits and the upper limit. And I've got a single company, so the calculation is 3/200 over effectively £150,000, which is £2,250. And therefore the CT liability is £25,000 less the marginal relief of 2250, taking me down to £22,750. Alternatively, as a quick fire check, you could take the CT on the augmented profits of 100,000, could be calculated as £50,000 at 19%, £9,500. The next £50,000 at 26.5%, taking you to 13,250, and therefore the CT due is at 22,750. As you can see, two different ways of calculating the marginal relief, but they come to the same figure of 22,750. One way is to charge it all at 25% and give you the marginal relief on the closer the profits are to 250,000, the less marginal relief you get. And the closer you are to 25% tax, the closer you are to £50,000, the closer you are to the 19% effective rate. But it can be calculated, say, also by looking at the first 50,000 at 19% and then the balance at 26.5%. And then you've got to worry about, let's say I've got an accounting period spanning the 1st of April 2023. What I've got to look at is for the first quarter of that accounting period, let's say it's to December 2023, the first 3 months are at 19%. And then the balance of the period is in the new regime. So in the last 9 months, the good news is I've only got 3/4 of my profits subject to the higher rates of tax. The problem is that I have to prorate down both the higher rate from 250,000, the high rate threshold of 250,000 is prorated down to 187,500, and the 50,000 small companies rate is prorated down to 37.5k. So effectively, I end up with smaller marginal relief because I'm prorating down. I've only got 3/4 of a year of profits. I only get 3/4 of the benefit of the thresholds. I therefore work out the marginal rates on that basis, and I've got effectively £75,000 tax at 25%. I then get the marginal relief of 1,687. So the total CT due in the 9 months is 17,062.50, £17,062.50. Once I've done that marginal relief calculation, I add it to the original 4,750 for the first 3 months, and that will be payable in one payment on the 1st of October, on this case, 1st of October 2024, i.e. 9 months and 1 day after the end of the chargeable accounting period. I don't have to do the payment at 19% earlier than the payment at the higher rate. It's still one chargeable accounting period, and therefore the payment is due 9 months and 1 day after the end of the chargeable accounting period. A different way of looking at it, it would be again the first 37,500 at 19%, 7,125. The next £75,000 minus the 37,500, which has already been charged at 26.5%, 9,937.50, and the total CT due for the 9 months, 17,062.50. At that point, all I've had to do is prorate down the 50k threshold. I get obviously the other £12,500 of benefit in the next chargeable accounting period. I'll leave that up there for a second. And of course, that 17,062.50 is then added to the 4,750 that I owed for the first 3 months. As I said, in terms of the associated companies, the lower and upper limits, the more associated companies, the more those limits go down. So if a company does have associated companies, the limits are divided by the total number of associated companies, including your company. So if I have 5 companies in association, it doesn't have to be a group, could be an association, and the definition of association is wider than the definition of a group, because it includes, if I personally control 2 companies, that doesn't create a group for corporation tax purposes, but it does create an association on that basis. The other element, just to deal with just before we go for our well-deserved coffee break, investment zones, 38 local authorities, in addition to the Freeport regime. We are not sure whether that will continue. Question and answer. Does associated companies include non-UK companies? The answer is yes, it does include non-UK companies. So if I own, for example, a company in France and a company in the UK, that is 2 companies. Presumably it's worth considering deferring company pension payments to 22-23 to make payments in order to achieve the high CT relief, but also not losing the 40k allowance. Yes, absolutely, Chris. If you can organize the payments in those days, yes, you could get the additional CT relief and remain within the pension tax 40k for the year. So yes, that is one occasion where you can use the fact that the personal tax year and the corporate tax year have this 5-day difference. You make a payment between the 1st and the 5th of April, you can use the allowance for 22-23 and you'll get the additional CT relief. Okay, we're at 10 o'clock at this point. Let's take a 5-minute break at this point. Looking at investment zones now, this there is rumours that these investment zones may not go ahead as first anticipated. No one is quite sure at this point, and I'm assuming that this will be again clarified in the budget. And so the rumours that the investment zones, in addition to the Freeport regime, may or may not go ahead. The investment zone benefits on that basis. If they do go ahead, we're looking at 100% relief from business rates on newly occupied or expanded premises, 100% first-year capital allowances on plant and machinery that will be particularly useful for those who exceed the annual investment allowance. The structures and buildings allowance, which is the allowance on the building itself, was supposed to be at 20% per annum, which compares to the normal 3% per annum in normal areas and 10% in Freeport areas. Again, not certain whether that is going ahead. No employers' national insurance on salaries of new employees up to £50,270, and also full SDLT relief for both land and buildings for commercial use and development, and for land or buildings for new residential developments, which could be quite expensive. Somewhat controversial because they were also looking to reduce planning restrictions. But again, if they do go ahead, and with the Freeport regime as well, in terms of insulating yourself from higher taxes, that could be one of the elements. Another element that people need to think about quite carefully is the use of the budget loss relief. So effectively, during the 2 years of coronavirus, which the restrictions basically coincided very much with the 2021 tax year. Basically, it started March 23rd, but effectively in the tax year beginning April 5th, 2020 to April 6th, 2020 to April 5th, 2021. And then the final restrictions were lifted February 2022. So effectively for the 21-22 tax year, so 2021 and 21-22, for the 2 years to 5th of April 2022, you've got relief for trade losses that are made. And instead of being able to just use them against other profits in the year, or carry them forward, or carry them back 1 year, there is the potential to carry them back 2 years, and then if still there are unused losses, potentially 3 years in total. In terms of corporation tax, the amount of trading losses that can carry back to the preceding year remains unlimited. So if I've made a £5 million loss in 2020, I could carry that all back. And if I've made a profit in 2019 of £5 million, I could carry it all back and relieve it. But after carrying back to the preceding 1 year, a maximum of 2 million of unused losses will be available for carry back against profits of the same trade to the earlier 2 years. And this 2 million limit applies separately to the unused losses of each 12-month period within the duration of the extension. So I get £2 million for 2021, £2 million for 2022. And I don't get, if my losses are 3 million in 2021 and only 1 million in 2022, then the maximum I can carry back is 2 million out of the first 3 million of losses, and in the subsequent year only the 1 million. So 3 million of losses can be carried back in that circumstance, because I didn't have sufficient losses in 2022. So important to understand that it's 2 million per year of loss, and you could have a situation where actually the limitation there is the problem is that you have too many losses in 1 year and too few in another year, and that limits the loss that you can carry back. The 2 million cap will be subject to group level limit, requiring groups with companies that have capacity to carry back losses in excess of a de minimis of 200,000 to apportion the cap between its companies. So let's take an example, because I always think examples help matters. Let's say I have a current year loss of £5 million, and in the prior year I've got a profit of £1 million. On that basis, what I can do is the current year minus one is an unlimited position, although I'm only using £1 million. So I can wipe out my profits in current year minus one, and that 5 million would then go down to £4 million. So that's under the normal rules. So what can I do in current year minus two and current year minus three? Well, remember, in the current year, the maximum losses I can relieve would be £2 million. So I take 2 million of the losses and I do it on a last in, first out basis, and I relieve them against the profits in current year minus two of £2 million, leaving me again zero profits. I've now used the current year minus one capacity and the limitation in current year minus two, which means that I cannot make a claim for current year minus three. If, however, the position had been reversed, and in current year minus one I'd had a £2 million loss, and in current year minus two I'd had a £1 million loss, I would have been able to relieve the current year minus one of £2 million profit. If I'd had a profit of 2 million in current year minus one and a profit in current year minus two of £1 million, so I swap the profits round: 2 million CY minus one, 1 million CY minus two, then actually the position would be different, because I'd be able to claim the full 2 million, wipe out the full £2 million of profits in current year minus one. That would be under the old rules. Current year minus two, if it was £1 million worth of profits rather than 2 million, I use 1 million of the loss and wipe out the profits in CY minus two, and that leaves me capacity of £1 million, which I could then use in current year minus three. So effectively, you have to look at two operations. One is isolating and saying the unlimited carryback to current year minus one, and then between current year minus two and current year minus three, there's a 2 million overall cap. I have to use it on a last in, first out basis. So on that basis, I wipe out the profits in current year minus two and have no capacity in current year minus three. So I hope that's clear to people. Question: are the slides going to be shared? Yes, I believe they are being shared. They are available and are being shared. But if you look at that basis, sorry, let me go back to that. The slides are being shared on that basis. So you will have them and you can download them in PDF format as well. So important to look at that. But what is the real issue with that point of the CT rise happening, which we've talked about in the 26.5%, is of course that the Treasury let the cat out of the bag, because what they said very clearly was that actually the carryback provisions would in the end save them money. Why? Because if you're carrying back, you're going to save at 19%, whereas if you're carrying forward, you might be saving tax at 25 or 26.5%. So therefore, you've got the choice between the cash flow advantage of carryback and the real greater tax advantage of carrying it forward, where your taxes may be higher. Of course, the other thing to consider is whether there's a major change in the nature and conduct of the trade and whether you're unable to carry forward the losses anyway. But, you know, some people will say a bird in hand is worth two in the bush. And it's something that you need to consider because it's not an automatic process that you would want to invoke the carryback. You may take the longer view and say, actually, on that basis, I want to keep my powder dry and use my losses against the higher CT rates coming next year. Okay, let's look a little bit more at the CT planning and really just to summarize the point. First of all, to review whether you've got any unnecessary companies within your structures that will affect your limit. Two, to accelerate income of the company and potentially defer expenses. On the basis that income tax rates may not rise and indeed may fall, it would be better to take more out of the company in 2023-24, either in terms of bonuses or salaries. Now, we know that the income tax reduction in 23-24, so for the next tax year, has been cancelled, but 24-25 is the tax year in which there is likely to be a general election. And on previous records, tax rises tend to be followed by tax cuts just before general elections. Obviously, in terms of taking pension contributions, from the 1st of April 2023, it would act as potentially obtaining an additional 6% deduction against corporation tax. If you're looking at deferring income, obviously you might be potentially deferring income into a period when tax rates may become more beneficial for individuals. And here I'm talking about not thresholds, where the thresholds are being frozen, I think, until 2026, the personal allowance, the higher rate threshold and the additional rate threshold, but it is not inconceivable. And I would generally say my slightly jaundiced view on what governments do just before elections, it is quite possible that tax rates may fall in the year before a general election. Let's look at the super deduction on the question of capital versus revenue. The strategy announced in the budget in March 2021 was to create the super deduction and therefore make the decision as to whether the capital allowances were incurred pre or post April 2023 as a tax neutral decision. However, the Chancellor, who then was Rishi Sunak, indicated very strongly in the spring statement he's looking to increase capital allowances in April 2023, which companies may be able to take against the higher rate of CT, so it's no longer a one-way bet. So we've already seen the extension of the annual investment allowance by the £1 million annual investment allowance as indefinitely on that basis. And therefore, on that basis, it's not a one-way bet that you definitely want to accelerate your capital expenditure on that basis. And I say the AIA has been extended. The element which is not tax neutral is, of course, revenue expenditure. Revenue expenditure you get as 100% deduction, and therefore on the basis that it's 100% now, 100% in April 2023, not with 130% uplift. The point would be is that you're probably better off deferring revenue expenditure until April 2023. That could be pension contributions, salaries, if you can, bonuses, and any other type of revenue expenditure. If you can defer it until April 2023, that might be a very good idea. So deferring expenditure, accelerating income seems to be a good idea on that basis. The things that you need to think about will be with the changes of rates. I mean, if you have a small company that has profits below £50,000, then the effects of these changes are pretty neutral. But you do want to look at things such as revenue expenditure and capital expenditure. Revenue expenditure is actually less generously treated than capital expenditure until April 2023. But again, as I say, deferring revenue expenditure may be a good idea, whereas bringing forward capital expenditure may also be a good idea. Research and development, there are some changes which I hope to come to in the last part, but again, look at your R&D policy. Some R&D may be a good idea to accelerate, particularly where you're looking at companies who have expenses overseas, and where these are going to be limited from next April. With other elements, cloud computing, data, and pure mathematics, it may be a good idea to defer the R&D until next April. The dividend policy you're going to want to look at carefully, although, again, the issue with dividends, I suppose, is that you need to think about the fact that they're not deductible for CT purposes. So, in effect, become more expensive come April. And also incorporation, and obviously with the reduction back to 9% for class 4 national insurance contributions, but increased taxes on companies and dividends, incorporation has again become somewhat less attractive. Going to look at another issue in terms of something which just very briefly a change from the Finance Bill 2023, separation and divorce. So we've seen a spike in separations and divorce. Some people think it's because of COVID, and some people think it's because of the new no-fault divorces, and recent figures have shown a particular increase in that area. One of the elements you need to think about is, of course, the current rules are based on no capital gains tax on a transfer of assets in the year of separation. But in the tax year after separation, there would be a CGT liability, potentially on a transfer of assets. The new law, which is due to come in from April 2023, gives you a potential 3-year window to effect transfers on a nil gain, nil loss basis. Other elements to consider, and this is an area where the government keeps on looking at potentially changing the rules, but it's a good time to consider gifts out of regular income. The tax return should have indicated the levels of income and tax. Makes a good starting point for the calculations of surplus income that can be given away. You should note that a successful gift is a gift out of regular income is neither a potentially exempt transfer, so it doesn't start the 7-year clock on that basis. It is immediately out of your estate. So if I earn, I don't know, £200,000, and after tax I have 50,000 tax and expenses, I have £50,000 of surplus income. If I give that away in gifts to individuals, that is not a potentially exempt transfer. That is a gift out of income and falls immediately outside my estate. And if I put it into a trust, there is no entrance charge on that amount of money. So anyone looking to use this exemption from a deceased state must give details of the gifts on page 2 of Form IHT 403. Also give details of the deceased income and expenditure during the period when the gifts were made, either completing page 6 of IHT Form 403 or sending in their own supporting schedule. If you're looking at setting up a spreadsheet, and it is generally easier to do it with people who are alive rather than dead. So, you know, setting up a basis of making regular gifts while you are still alive with a view to reducing your IHT liabilities. This is the sort of information required. This is from gifts made as part of normal expenditure out of income. The first page looks at your income, less the income tax paid, which is your net income. The second page looks at the expenses, then gives you your surplus, then gives you your gifts made for the previous 7 years. And therefore, on that basis, you would end up with a potential surplus amount of income, which would be outside your estate for IHT purposes. Okay. Any questions? So other elements, what can I think about in terms of tax planning for higher taxes? Well, one of the good pieces of news was company share option plans, the £60,000 limit. So it has been since about 1996. So we're looking at, you know, 26 years, the CSOP limit has been at £30,000 based on the amount of unvested options that you could award to individuals, and broadly speaking, they would not be subject to income tax and national insurance on the gain. They would only be subject to capital gains tax when the shares are sold. And we'll talk about that a little bit later on. Look at other tax efficient share incentive plans. What happens if you expand overseas? Tax relief for investments, intellectual property, and IR35. So shares for growing companies, that's what we're looking at on that basis. So reasons for implementing a share scheme, you look at retention, recruitment, improved performance, long-term employee shareholding, delivering an effective tax compensation. Other elements which are important are minimizing the cash cost, and possibly the accounting cost, but definitely the cash cost is something that you might look at. Matching competitors, utilizing new dividend allowances from April 2016, and obviously a combination of the above. But particularly where there is a real skill shortages and a competition for talent, it's an area of considerable interest. And I think with the CSOP being doubled to £60,000, a lot of people are going to look at share schemes as a potentially very tax efficient way of increasing your net benefit to employees, whilst also increasing the ability to retain key employees. That is what share schemes is all about: retention and incentive at reduced costs to the employer. Let's have a look at the grant. So what is a typical share scheme? So I grant my options at, say, £1. They have a 3-year period until I can exercise my right to buy the shares. An option gives me a right to buy the shares. I then exercise my option. I give him my £1. I get a share which is now worth £4. If it is non-tax advantaged, I pay income tax on the gain of £3 at that point. If it is tax advantaged, like in a CSOP plan, then I only pay tax at capital gains tax rates on the value when I sell the share. So if I sell it and the share has gone up to £5, the effective, my cost, I bought the share at £1, I've sold it at £5, I've got a capital gain of £4, which I might be able to use against my annual exemption of £12,300. And even if I can't, the rate of capital gains tax, maximum rate for shares at 20%, is considerably lower than the income tax rate. So that's a particular profile of a share scheme, looking to incentivize employees over a longer period, but getting considerable tax reliefs. And those tax reliefs have only become more valuable as tax rates have gone up. Let's take an example here. So Kirsty is granted 10,000 options on the 6th of February, of course, 2022, when the market value was £1. This was the strike price. The vesting period was 3 years. And the options needed to be exercised within 10 years of the grant. So that's on the 6th of February 2025, the share price was 90p and therefore underwater, and therefore Kirsty did not exercise her options at that point. On the 6th of February 2026, the share price had risen to £2, and therefore Kirsty exercised her option to purchase the shares. She makes a gain of £10,000. The exercise price, or the value of the shares at the time of exercise, is 20,000. The strike price, £10,000. If you look at tax advantage versus non-tax advantage, Kirsty makes a paper gain of £10,000, assuming she's a higher rate taxpayer. For a non-tax advantage plan, she will pay £4,200 in tax and national insurance, leaving £5,800 of proceeds, and the company, assuming the rate remains at the rate it's due to on Sunday, 13.8%, the company would pay 13.8% national insurance. If it's tax advantage under a CSOP plan, then you're looking at making a paper gain of 10,000. That becomes a capital gain when she sells the shares. She has no other gains in the tax year. She can therefore sell the shares CGT free, and no national insurance for either the employer or the employee. Now, fast that forward to today. Let's say I decided to take advantage of the full 60,000 CSOP. Let's have options which are worth £60,000 today, £1 options on that basis. Effectively, let's say the share price goes from £1 to £11 on that basis, and I have 60,000 options. I'm making a gain of £600,000 on that basis. That would be subject to tax for Kirsty, presumably then on that basis, as an additional rate taxpayer at 45%, which would be £270,000. And then on top of that, if I've got £600,000, I've also got national insurance at presumably 2%, which is another £12,000. So £282,000 of cost to Kirsty. So we're coming close to half the money, half the gain disappearing. And then the company on that gain of £600,000 would be paying 13.8% national insurance. So therefore, on that basis, another £82,800. If that was a CSOP, then the company would save all the national insurance. So the 600,000 times 13.8%. So the company would save £82,800. And instead of Kirsty paying £282,000 on the gain, let us assume that of the £600,000 gain, she's chargeable on, say, 500,000 of the gain, because she's sort of transferred some to a spouse, some she's put in an ISA on that basis, and maybe she's split the sales between 2 years, doubling up her annual exemption. Let's say she has £500,000 of gain on the shares at 20%. We're looking at her tax bill dropping from £282,000 to £100,000. So huge potential advantages of using CSOPs. Just a quick reminder about how the difference between cash versus shares and options. Cash obviously is simple, but subject to income tax, whereas shares and options would be subject generally to CGT treatment, or could be if they're tax advantaged. Company and shareholders, if they give out cash, there's no dilution in their share interest, whereas under shares or options, there's definitely a dilution issue to be concerned about. Cash cost of bonuses, you get employers' NIC on top, but you do get a CT deduction. But the other element is if it's shares or options, so that's the advantage of cash, you end up not having to pay cash out. And it could be obviously that if you've got an exit related scheme on an IPO or trade sale, that actually it's the buyer of the company who is funding the shares, not you. There's possibly no, as I say, employer's NIC, and you may get a CT deduction, although maybe not the full deduction for the full market value of the shares. It all depends on the circumstances. But generally speaking, shares and options, particularly tax advantage shares, give you significant tax advantages. Also, a reminder in terms of the taxation of dividends, the effective rate, 2223, £2,000 allowance, then 8.75%, higher rate, same 2,000 dividend nil rate ban, 33.75%, 2,000 allowance, then 39.35% is the rate for dividends. And of course, you're not getting, but what you're not getting on dividends is, of course, the CT deduction. In terms of the big advantage for dividends, those are the one of the advantages is the allowance itself, but the other potential advantage is, of course, that dividends are exempt from national insurance, except if classified as earnings. There have been a few cases like PA Holdings where dividends have been classified as earnings, but they are fairly few and far between. And that still gives a significant advantage to dividends over earnings. But of course, with national insurance coming down on Sunday and the dividend tax remaining at the same high level, the gap is being eroded. Also important to understand the differences between shares versus options. So a share is a share of the company. It does what it says on the tin. You have a right to dividends. Is your money at risk? Yes, if the share price goes down, as a lot of people have found out, your money is at risk. But you do have voting rights, which can be very useful in a smaller company. Options give you a right to buy a share in the company at a predetermined price. So, in the same way that people had a right to buy council houses at a predetermined price, an option gives you a right to buy a share, normally at the market value it sits at the time. So in the examples I've had before, you've had the right to buy the shares at market value. If they're at a pound, that's the price you'll pay in 3 years' time. You may have made a paper gain, but that gain will not be subject to tax if it is a tax advantage plan. You don't have a right to dividends under an option, and if a company gives you dividends because you're an employee, that would be employment earnings. Is your money at risk? No, because most option schemes don't force you to purchase the shares. So therefore, an option generally is a risk-free proposition for the employee, but there are no voting rights. If I look at tax advantaged plans, there are four. The share incentive plan, which offers you shares, and I'll talk about that. You get tax relief on the contributions. It is an all-employee plan, but there's no limit on the size of the company. Share Save, which may become more popular again as interest rates rise. CSOP, which I've just talked about, which is the normal option plan. Share Save as you earn is a regular savings plan, needs to be given or be offered to nearly all employees, whereas CSOP can be done on a discretionary basis. And then, of course, you get EMI options. Again, should be considered by small and medium-sized companies with gross assets of less than £30 million. Again, a discretionary scheme does not need to be given to all employees. As I say, generally the features of these schemes are that they minimize or eliminate altogether income tax and national insurance, and you end up, the major charge that you have is capital gains tax. But even with EMI schemes, shares acquired through an EMI scheme, you can get business asset disposal relief, so you only pay capital gains tax at 10%. Any questions on that? SIP shares are particularly interesting because the element in terms of SIP shares that I think is useful, let me deal with that now. I'm going to move on in the slides and then I'm going to move back. So if you're following, it's on, I'm going to move on to the slide on that. I wasn't sure I'd get time. That'll be on slide 91. And then I'm going to move back to corporate issues. So let me move on to that. And then I'm going to come back to other areas. So share valuation. For UK tax purposes, HMRC will expect the market value of a small holding in an unquoted private company to be substantially discounted from its pro rata value, up to 75 to 80% in many cases. To protect against future income tax and NIC charges, you would then do an upfront 431 election. So let's say I've got shares, the grant price is the market value at £1, or the shares are being given to me on a restricted basis, but they're at full market value. I will either pay that market value or I pay the tax on that market value, and I would do a 431 election. On that basis, there would be no further income tax or national insurance liabilities. There would only be a a capital gains tax liability. If an election is made, the uplift in pro rata value when the company is sold as a whole is free of income tax and national insurance. So what do I mean by that? Let's say I've got a company which has is worth £10 million. And you, as the owner, give me an employee £1 million worth of shares, or 10% of the holding. Now, do those two things equate? Is a 10% share of a £10 million company actually worth £1 million? And the answer to that of a private unquoted company is probably no. And HMRC recognize that, because what they'll do is give you a discount, because an unquoted company generally doesn't pay dividends on a regular basis. Secondly, your voting rights at 10% are very limited in their value. And thirdly, and probably most importantly, you don't have any liquidity. In other words, with a quoted share, I can just go to Hargreaves Lansdowne or any other brokers and sell them in 15 seconds and get my money pretty quickly. Here, with a private company, there's no guarantee I can realize that money, because if there's no buyer for the shares and it's not on an exchange, I'm stuck with the shares until I get a buyer. So on that basis, you might then think to yourself, if I've got a £10 million company and I'm given 10% of the shares, it's not worth £1 million. The actual inherent value of those shares at that point is maybe only £250,000. I get a 75% discount. And that may be agreed in certain cases by HMRC. What that means, however, is I'm holding these shares with limited voting rights, with limited voting effect, with no easy exit for those shares. I can't realize the value, and no guaranteed income stream. You're going to get a discount. The point would be is if the company is then subsequently sold for £10 million, I have 10% of the shares. Those shares would be sold for £1 million. And therefore the gain between the value on acquisition at 250,000 and the value when sold at £1 million, so £750,000, would be subject to capital gains tax. And in addition to that, because I'm holding more than 5% of the shares, assuming I've held them for more than 2 years, so I'm holding more than 5% of the share capital, assuming I've held them for more than 2 years, I should get business asset disposal relief, if I haven't used that up already, and therefore only pay 10% capital gains tax on the £750,000 gain. And that can give a really big advantage for shares in an unquoted company. But even if you're thinking about not giving substantial shares, one of the things you could think about would be a share incentive plan in a small private company. Assume that the company is working towards an exit event, and the intention is to allow all existing employees to benefit at the time from owning the shares. I could give shares away in a share incentive plan, and potentially, although I can put in an 18-month qualification period, they would have to be available to all employees. But let's say I've got a coterie of employees. Some of them are senior, some of them are middle management, some of them are junior employees, and I want to incentivize them to work towards a buyout. You could end up with a structure where under the EMI plan, I give significant options to my senior employees. Under a CSOP plan, I give significant, but obviously lesser number of options to my middle management, and everyone gets the share incentive plan. So give an example with the share incentive plan. What if the company establishes a qualifying share incentive plan? It invites all qualifying employees to subscribe for, say, £1,800 worth of fully paid up non-voting B shares out of pre-tax bonuses. Now, I pay for the share under the SIP plan, but I get a full tax and national insurance deduction at my top rate. And if my top rate's at 45%, I get a deduction. The unrestricted market value of the shares agreed with HMRC to be at a 75% discount to the pro rata value of an ordinary share. I get the discount there because it's a minority interest. If and when the company is sold, either after 5 years or for cash, after, say, quadrupling in value, the investment of £1,800 would produce a return of £28,800 tax-free. I could then also offer matching shares at no extra cost, potentially because the company is making an employer national insurance saving as well. And that could give me £31,680 effectively tax-free. So if you look at that basis, that gives you a significant potential advantage for growth, which would be completely tax-free within a tax advantage approved wrapper. So something that you might want to think about is a SIP plan. And as I say, as tax and national insurance has gone up, you could end up with significant income tax, national insurance, and indeed, because you get, the shares could be issued and gifted, you would still get a CT deduction on the value of the shares that go into the trust. In terms of the summary of the opportunity there, what you're looking at is if you decide to go for a SIP, what you could be looking at there. Why is this not moving? It could allow any independent company, including, say, a closely held investment company, to enable its employees to benefit through share acquisition in a manner which affords very generous tax reliefs. You could use standard form documentation. SIP shares can be awarded relatively quickly and cost effectively, particularly in times where taxes are relatively high, but there is a shortage of key staff. This is an area that could really, I think, people need to look at very carefully. Then the other area that I would look at before we take the second short comfort break would be EMI options. So if I look at EMI options, seems to be getting lots on the chat, but it's all about recordings rather than questions. EMI options, more popular, used more often. They were seen as a form of state aid and therefore regulated under European rules before we left the European Union. Now the UK has UK government has the opportunity to change the rules and extend them. It is a possibility to do so. Generally, for small high-risk trading companies that cannot otherwise afford to attract talent from large corporations. This, as I indicated, was a £30 million limit. So it is designed to give a competitive advantage to small and medium-sized companies in what is a generally hot market for skilled employees. It is a highly favorable tax instrument, afforded rights to acquire ordinary shares in a qualifying company to an eligible employee. The qualifying company must be a trading company or holding company of a trading group, must not carry on non-qualifying activities. So generally it's trading companies. So with the CSOP, where the limit has gone up to 60,000, you haven't got all these restrictions. So if you can't use EMI, you might think about CSOP. Can't have excluded activities, must have less than 250 full-time employees. And as I said, gross assets must not exceed £30 million. What can you offer on that basis? So the individual limit presently is £250,000 on the aggregate unrestricted market value. Remember, you can still get discounts, of course, because the shares will quite often in an unlisted company. So you can offer up to £250,000 worth of options to key employees. There's an overall limit of £3 million, and you won't always want to grant them all at once, because if the share price goes down and you want to cancel and re-grant the options, to the extent if you are at the 3 million limit, you have to wait 3 years after cancelling the options before being able to reissue more options at a lower figure. But you've got two elements which are very generous. One is 3 million of options potentially on an unquoted company, which would be most of the share capital of most unquoted companies. So it's quite a high limit. And £250,000 worth of options valued at grant for an individual employee. You have to look at the excluded activities, which unfortunately also include legal and accountancy services, property development, farming and market gardening. So asset-based elements where you've got an asset which is, which guarantees a value in the company. Some of these rules are derived from European law, and I'll be interested to see whether they change as this new review of European law goes through. But that still leaves quite a lot of small and medium-sized sort of trading enterprises which could benefit from EMI. And as I say, you would get on the options themselves, you would get a CT deduction. So to give an example, let's say I had an option. The market value of the option is at £1. And then when I exercise the options on the exit, maybe they are valued at £11. I make a £10 gain as an individual, no income tax, no national insurance, and possibly CGT only at the 10% rate as discussed before. From the company point of view, what makes this so attractive is that maybe they're newly issued shares. There's a spread of £10 between the price I pay for them as an employee and the value that the company's giving them to me at. But the company can take that £10 spread, between the £1 and the £11, as a CT deduction. So let's say the company had granted me 100,000 options, and now there's a gain of £1 million. That £1 million would be CT deductible. And something certainly when you've got mergers, acquisitions, and transactions, if EMI options are going to vest on that basis, it is important to calculate the CT deduction, because it could be that if you sell the company, that actually it is the buyer of the company that gets the CT deduction, but the seller should take that into account when looking at the price paid for the company. Couple of other very simple points on that basis. They do need to be, in terms of eligible employees, they need to spend 25 hours a week, or if less, at least 75% of their working time has to be spent with that company. Now, these rules were relaxed for the COVID period, but that relaxation came to an end on the 6th of April, 2022. So this rule of at least 25 hours a week or 75% of working time is important to look at. And it's a particular issue where you've got employees cutting down their hours leading towards retirement. Less of an issue in terms of maternity, paternity, or other elements, but is an issue where people are reducing their hours leading to retirement. The employee can't have a material interest in the EMI or any member of the group, which is normally 30% ownership when aggregated with your associates. The terms need to be written option agreement, and must be capable of exercise within 10 years and have a number of elements such as must state the date of grant, number of options, the shares under which are under option, the exercise price, when and how it may be exercised, any performance conditions, and if there are any restrictions in the articles of association, they need to be included in the option grant terms. And also the options themselves are non-transferable. However, what some people might do is once they have exercised their options and got the shares, they may transfer some of the shares on a nil gain, nil loss basis to a spouse or civil partner to use up his or her annual exemption and low rate tax band. So these are the most tax favored arrangement for employee share acquisition, and you can get what is now the business asset disposal relief rate on the gain. What you're looking at here in terms of growth is diagrammatically here is there's your grant price pound. The exercise would be exempt from income tax. And then when you sell it at the final line, there would be capital gains tax potentially, but maybe only at 10%. Okay, at this point, let's take a 5-minute break at this point, and I'm going to go back to talk a little bit more about R&D, and also I'm going to talk a little bit about some of the allowances as well. Hi. So really, I want to look at just a quick reminder here, a couple of FA 2021 points for expanding clients. So the 130% capital allowance relief still available until April 2023, and of course investment in free ports. New allowances for expenditure by a company incurred between the 1st of April 2021 to the 31st of March 2023, where the contract was entered into from the 3rd of March 2021. What we're looking at is expenditure on plant and machinery will be eligible for the 130% super deduction for the cost, and the 50% first-year allowance for qualifying special rate pool, plant and machinery assets acquired. So, for example, long life assets and features integral to a building. Now, if you are looking at the 50% first year allowance, you'd probably want to use that against the AIA first. So use up your 100% AIA before you use the 50% first year allowance. But then again, that does really depend with the second one, whether actually you want to use it up against a 19% CT rate, or do you want to defer the use of the capital allowance on the long life assets and spread that over a period of time and use that against the 25% rate of tax. In terms of the 130%, you've now got November, December, January, February, March, so 5 months to use it up. So what are we looking at? Well, we've got to look the anti-avoidance committed expenditure before April 2021 was not allowed, probably not an issue now, except for in terms of looking back and seeing what you can claim. Used or second-hand assets wouldn't work. Contrived arrangements, unsurprisingly, excluded under existing capital allowance rules. And for periods straddling the 1st of April 2023, you're only going to get the partial uplift. Why are they doing this? Well, you spend 10 million on an investment, you get a deduction of 10 million at 130% is 13 million. CT at 19% saves you 2.47 million. So you're getting a 24.7% rate. Why is that important? Well, it's close to the 25% rate. And the reason the government introduced this was to stop people thinking, actually, I want to defer my capital expenditure until the income tax rate, until the corporation tax rate goes up. So in other words, without this 130%, a lot of companies, we would have been saying to a lot of companies, defer your capital expenditure until the rate goes up to 25%. What they've effectively done is give you the advantage of the 25% rate and made the decision about whether to spend money before at the end of the tax year or after the end of the tax year, a fairly tax neutral basis. As I pointed out in the first part of the session, this is tax neutral for capital expenditure on plant and machinery. It is not a tax neutral decision on revenue expenditure, where definitely the deferral of revenue expenditure into a period with higher corporation tax rates seems like a pretty good idea. Let's also then look at, plant and machinery as I say, one of the other elements that you might think about in terms of plant and machinery is, of course, not only about the AIA, but there may be other incentives announced on the 17th of November. The interesting point was that Rishi Sunak, as Chancellor, reversed quite a lot of the tax thinking that has been around for the last nearly 40 years. So the general tax thinking was we reduce the rate of corporation tax, and we fund that by reducing some of the investment reliefs. Rishi Sunak has to a certain extent reversed this by increasing the rate of CT, but is also looking to encourage British industry to invest by making those investments more tax effective from that point of view. One of the elements is, of course, the free port regime, different to the investment side. So as far as I know, that will definitely go ahead because it's a Rishi Sunak idea. So 8 sites in England, there's, I think, at least 1, maybe 2 sites in Scotland have been announced. And more sites in Wales and Northern Ireland to be announced. East Midlands Airport, Felixstowe and Harwich, Humber, Liverpool City Region, Plymouth and South Devon, Solent, Teesside and Thames. Those sites, the only one of which is not by water is, of course, East Midlands Airport. There's a 10% structures and buildings allowance, 100% enhanced capital allowances for investment in plant and machinery. And that is for expenditure incurred up to the 30th of September 2026. So giving you enhanced basis in terms of both the buildings and the machinery in the buildings, and those reliefs or the reductions are for expenditure in effectively another 4 years. No SDLT on land or property purchased up to the 30th of September 2026. Full business rates relief for new businesses and old businesses which are expanding from 5 years from the date of first relief, and also relief from employers' NIC on eligible employees from April 2022 until at least April 2026. And there's an intention to extend it to April 2031. So again, in an era of raising higher tax rates, some of the investment opportunities are still there and still worthwhile to look at. Then I want to look at R&D tax reliefs. Why? Because there are a significant number of changes to R&D tax reliefs, both potentially positive and negative, depending on your perspective. It was interesting that HMRC publicized only a couple of days ago that they'd arrested people in connection with some alleged R&D tax frauds in terms of making fraudulent claims for R&D tax relief. So they are focusing more on the compliance side of this. And they're looking both to expand the scope of R&D, but also to make sure that as far as possible, those claims are valid claims. So what's it about? Well, it's a use of tax incentives, as I say, as a policy tool to encourage desired behavior or discourage non-desired behavior. And R&D is generally seen as a good thing, creating what they call high-skilled, high-paid jobs in the UK, creating a more vibrant UK economy. In terms of R&D tax relief, so there's an SME relief, which is a super deduction of an additional 130%. Note that the plant and machinery allowance is effectively an addition of 30%. This is an addition of an additional 130% allowable to small and medium-sized companies, which means you spend £1 million on R&D as a small or medium-sized enterprise, you will get a deduction against corporation tax of 230%. So 230,000 deduction. For large companies, they have this above the line research and development expenditure credit of 13%. That rate went up in April 2020. What is sort of qualifying expenditure, where you look at staff costs, software and consumable items, qualified expenditure on externally provided workers, and this is one of the areas that the government is looking to crack down on. Similarly, they're looking at subjects of a clinical trial, although obviously with all the COVID and pharmaceutical developments, that is being encouraged. But the other area that they're concerned about is subcontracted payments of a similar nature. So what is an SME for these purposes? Well, an SME has less than 500 employees, gross assets under 86 million euros. That is not a typo. It derives from European law, and a turnover under 100 million. So if I look at R&D, the definition of R&D is based on two tests. First, the activity in question must be one that is treated as R&D under generally accepted accounting practice. And secondly, the activity must also fall within the guidelines issued by the Secretary of State for Trade and Industry, or now the Business, Energy and Industry Skills Department. I'm trying to remember, it was Jacob Rees-Mogg. It keeps on changing so often. I'm trying to remember who it now is, and I've forgotten. Sorry. Keeps on changing. If it comes back, I will let you know. But the Secretary of State for Business, Energy, Industry and Industrial Strategy issues those guidelines, or rather the civil service does it, and then the Secretary of State will approve them. The super deduction here under R&D is that qualifying expenditure gets an additional deduction in the tax computation to the extent that it creates or increases a loss. The loss can be used in the normal way, or a payable tax credit can be generated. Now, what they are looking at is the payable tax credit to be restricted to discourage work being done outside the UK by subcontractors. So, and we'll talk about the restrictions in a little bit. For larger companies, what you're looking at is the above the line tax credit. R&D credit is included as a receipt in the company's tax computation. So effectively, the first thing is it's bad news in that the credit is included in the computation and you pay corporation tax on it. However, the good news is that once you've done that, you can then take the credit as a pound for pound reduction in your CT liability on that basis. So take a simple example of the RDEC in operation. What you're looking at there is estimated R&D spend of £1 million. You add the 13% enhancement rate. So £130,000 above the line credit. You would pay corporation tax now at 19%, which gives you effectively a tax rate, a tax of £24,700. If you deduct that against the £130,000 pound for pound credit, you end up with a net benefit of £105,300. You paid CT on the credit, but you get the £130,000 as a pound for pound credit. The net benefit is £105,300, which is 10.53%. The important element there, of course, is if the rate goes up to 25%, effectively you get 130,000 at 0.25. So you will pay your CT liability on the credit goes up from £24,700 to £32,500. That's still when you take off the 130,000 credit, you net that off, will give you a benefit of £97,500, therefore benefit of 9.75%. What that means is that if all things remain equal and he doesn't change the rate of our debt, the 13% enhancement rate, you are better off incurring that expenditure as a large company in this tax year. However, if you're a smaller company, but your rate of corporation tax is actually at 25 or maybe 26.5%, then you're better off postponing the expenditure and getting the super deduction, which is a deduction against your profits chargeable to corporation tax, and get that benefit next year. So if I take the company spending £1 million on R&D on that basis, they get 230% as a 230,000 as a deduction. If they were deducting it at 19%, their net benefit is 43,700. If, however, they are deducting it at 25%, then they get an advantage of 58,250. Obviously, if they're then in the marginal rate, and the marginal rate is at 26.5%, the value of that deduction would be over 60,000, nearly 61,000 pounds. So effectively, RDEX, you want to move forward. SME relief, you actually want to postpone if they're paying, if their profits are above £50,000. In terms of R&D relief, the Finance Bill 2023 proposals, which were done when Rishi Sunak was Chancellor, and therefore I don't think are going to get changed very much. Also, they've been kicking around as proposals for an awful long time. So there are two new categories of expenditure qualifying for relief introduced. They're the cost of data licenses and cloud computing services. A data license is defined as one to access and use a collection of data services. Cloud computing services, including providing access to and maintenance of remote data storage, operating systems, software platforms, and hardware facilities. Amendments will also be made to the patent box legislation, which applies to the R&D definitions of qualifying expenditure in its calculations to include data and cloud computing costs. So you've got cloud computing, data included, software platforms, remote data storage, and also you will now be able to get costs for pure mathematics. But there are other measures which have been done to try and improve the compliance in this area. Number one, all claims to R&D release will need to be made digitally. Claims will have to include a breakdown of costs across the qualifying categories and provide a description of the R&D. A claim will need to be endorsed by a named senior company officer, will have to include details of any agent advising on the claim. Additionally, companies will be required to inform HMRC in advance that they intend to make a claim within 6 months of the end of the accounting period to which it relates by making an online claim notification. There will be an exception, a relaxation for companies which have claimed in any of the 3 preceding accounting periods, and secondary legislation will detail the information that needs to be included with a claim or this new requirement of a claim notification. And they're doing this because they're worried about particularly unscrupulous agents who've said, do you know what, you'll get your claim through, HMRC hardly ever look at it, it's easy money. And of course, they're claiming large commissions maybe as a result of making these spurious and inflated claims. HMRC are cracking down on this as I said, they have made arrests recently, but they're also cracking down on this by increasing the compliance requirements there. Q&A. I believe that the R&D digital claim is coming in on the 1st of April. Other changes in terms of R&D, because obviously it is very valuable in terms of reducing your CT liabilities, but they've decided that there are too many claims being made for activities carried on outside the UK. And now that because we're no longer in the EU, they can limit those claims to UK activities. They don't have to worry about European law on that basis. So the relief for subcontracted work and externally provided workers will be limited to focus on UK activity. Expenditure must either be UK expenditure on R&D in the UK or qualifying overseas expenditure undertaken outside the UK. And that is because the necessary conditions not present in the UK due to geographical, environmental, social factors. So, for example, if you're doing deep sea ocean research or research on glaciers or tropical climates, you know, diseases in tropical climates, you obviously got to go to those places. However, what you won't be allowed would be an excuse saying that, or reasoning saying that the cost of the work and availability of the workers, you know, they're not available in the UK. That would not be sufficient reason to allow for work and activities outside the UK. Another Q&A. Yes, I think there is a recording after the calls as well. So what we're looking at here is very much more of a focus on UK activity, and to justify activities outside the UK, you're going to have to look at regulatory or climate issues which don't allow particular tests in the UK. Other points in brief: subcontracted out R&D work will only qualify for R&D incentives where the third party undertakes their R&D in the UK. Under the Research and Development Expenditure Credit regime, payments to qualifying bodies, universities or health bodies to undertake independent research will only qualify again if the activities are undertaken in the UK. So where, say, universities have branches in other countries or satellite universities, they will not qualify for relief if the activities are taken on elsewhere on that basis. And payments to externally provided workers will only qualify where the workers' salaries are paid through the UK payroll. So if you are a UK company, but you have some non-UK employees on your payroll, their costs can't be used for R&D. Think that's a bit too sweeping there. Why would I qualify that? Number one, you could have a non-resident who comes to the UK, remains on the home payroll. Now, that might limit, because your pay-as-you-earn costs are limited, that may limit the cash refunds that you can get. But what it won't do is per se stop you getting those activities qualified. So for example, let's say I came for 5 months and I wasn't subject to UK tax under the UK French or UK German double tax treaty, Article 15 2B. With this work, and the answer is yes, because those activities are carried out in the UK, albeit by somebody who's just coming in for a short period of time, those activities and those costs should be okay. If the employee doesn't come to the UK, they work from home, no, I don't think that's going to work. So post 1st of April 2023, that will then not work. If you've got people physically carrying out their activities in the UK, then as long as you can prove that's the case, then their costs should be allowable. So a claim for 31st of August 2021, those rules are not in there, and therefore it should be allowable. But I would very carefully look at the rules, because there are other rules regarding some contracted information, but those rules per se will not have come in on that basis. So it should be allowable on that basis. Obviously, there are plenty of other rules that you need to look at in terms of recording and what the activities were and did they add to the project and so on. But these rules are, say, coming in April 2023. So again, a question of whether you're looking to accelerate expenditure to come in before the restrictions on the rules, or indeed postpone expenditure if it's in one of the new categories that will now be allowed, for R&D, like data and cloud and pure mathematics, that will be allowed from 1st of April 2023. Obviously, you might want to defer expenditure for those. So bring forward foreign expenditure, defer expenditure on data and cloud. I hope that's clear. So that's one of the elements that you would want to think about. The other point would be payments to externally provided workers. What I've not seen in the legislation is about what if there are, as I say, a group from the group, but are coming here on assignment, but remain on a foreign payroll. And one would then need to look at the final details when Finance Bill 2023 is published in full to see whether they would be covered or not. Will VGTR, I'm having a bit of a brain fade here. VGTR stands for what? So when we get VGTR, I may be able to VGTR. Video game tax relief. The point would be is that video game tax relief, I've not seen any specific changes on that score, and I wouldn't want to answer it at that point, because obviously there is some interplay between R&D and video game tax relief, but the rules are separate, and so that you can't automatically read across. There are some changes being done to cultural reliefs at some point, but I don't know the full details of that, and they are beyond the scope of R&D tax relief. As I say, scrutiny on this point, all claims made digitally. Digital claims will require more details to substantiate the claims. Still not totally clear about that. We're looking at secondary legislation and regs, and need to make that notification. They'll also need to include details of any agent who's advised the company on compiling the claim, because I think HMRC has its own list and its own views about who is a reliable agent and who is not a reliable agent on that basis. In terms of other quick changes, so in terms of the legislative change, ensuring the time limits for R&D claims are 2 years after the end of the claim period. The companies do not fail the going concern test for technical reasons, i.e. there's a transfer of the trade. So remember that only going concerns can claim R&D, And what we're looking at is that, if there's a technical going concern issue, that should not affect you claiming R&D. And the R&D tax relief can be claimed provided the expenditure will be paid within 2 years of the claim period. In terms of the tax planning points, just to re-emphasize, you'd want to accelerate the research and development expenditure credit and decelerate potentially the SME relief if rules do not change. And then the final point on there is potentially accelerating the non-UK spend, but again, decelerate the data cloud computing and pure maths spend. At this point, can we take the second poll, please? Oh, so we've got the second poll. Let's have a look at the answers. Interesting. Only 4 people have said leaving the UK. So reviewing associated companies, always a good idea, because obviously you reduce the number of companies, you reduce your professional costs. But again, if you've got companies serving no purpose, that is something you would want to look at redoing. Deferring expenses, yeah, good from the cash flow point of view, but as I say, certainly with revenue expenditure, you might want to consider that, and of course, accelerating income. Thank you very much indeed. So let's look very, very briefly, because people aren't looking at leaving the UK, expanding overseas, the sort of issues that you need to think about in terms of expanding overseas is permanent establishment, in the employees you've got, VAT, customs, concierge arrangements, and profit expense shifting. And this comes back to the point with employees is if you expand overseas, you potentially create a CT liability overseas. There's a recent case which is of relevance, relatively recent case, a permanent establishment, Danish Tax Council was approached by a German company with an employee working from home in Denmark on a 6-month contract. The company sought a binding ruling about whether it created a PE in Denmark. The decision considered some issues relevant to evaluating PE risk and home working, and centered around 3 key points for a PE to exist: place of business that is fixed. It must be a location where the business activities are carried out. What the Danish Tax Council found, and this is relevant because they're operating over the same OECD rules as elsewhere, is that the employee's office was not irregular. The employee was building a Danish marketplace for the German company, and the activities performed were core to the German business. And the Danish Tax Council concluded the German company had created a PE in Denmark. Why is that important? Well, because the UK operates off the same rules on that basis. So when you're looking at that, that's a major issue. Look at the OECD guidance. The fact that a part of a business is carried on within an individual's home does not automatically mean there is a PE. However, as demonstrated by the Danish case, the facts and circumstances of each individual case should be analysed. An intermittent or incidental use of a home will not put it at the disposal of a business, but a PE may exist if a home is used for business activities. It's clear that the employees are required to use it for business for example, where a business has not provided an office where one is needed. Two subsequent cases involving Denmark, where they had an independent consultant that did not create a PE, and a Spanish case where the UK company wanted the employee to come back to the UK, and the employee didn't do so and operated from home. That again did not create a PE. But where you've got, and that was partly because the UK company did not want the individual to operate out of their home, and eventually the employee resigned. What it does show is that where no office is provided or alternative accommodation, and where the employee operates on a permanent or semi-permanent basis in their home, they could create a PE. The other element I want to talk about briefly is called profit diversion and fragmentation. And the challenges are where there's no SME exemption, no exemption in terms of, so the no SME exemption in terms of transfer pricing, and no £10 million threshold exemption for sales, or 1 million threshold for expenses, as you find in diverted profits tax. So this is really transfer pricing for small and medium-sized companies. This all came in April 2019, and with the increase in corporation tax rates, what you will find is that more companies come within the scope, because once you have a 20% tax advantage, now 20% of 25%, rather than 20% of 19%, you are potentially within these rules. The rule for looking at it is really to be inquisitive, because the sort of elements that you need to look at would be the family tree of companies, the flow of payments, the flow of income, ownership, formal and informal, control, formal and informal. And I think most importantly, having an inquiring mind on that basis. Because what you may have is a situation where a family has interests in the UK, and you take care of those interests in the UK, but they also have interests overseas, and their companies and businesses overseas transact with their UK companies. And if they're not on a commercial basis, then they could fall foul of the profit fragmentation rules. So you do need an inquiring mind. You do need to think about what I would call as the known unknowns about it, to understand that even if you're only responsible for the UK business, you may end up with a potential nasty tax adjustment to be made. So it's important to know at least some of the details about the overseas operations. In terms of the principles of CT and income tax deduction, it's not for business purposes. So, you know, the normal principle is if the expense is not for a business purpose, you don't get a deduction. You know, you can look at very old cases like Copeman versus Flood. You can look at more recent cases, but effectively the first principles are that there needs to be the expense needs to be for the benefit of the business. Generally recognized income when earned by a business, but that isn't necessarily enough to deal with intercompany transactions. And profit fragmentation in a nutshell shows there has to be a transfer of value from the UK to the overseas resident on a non-arm's length basis. The UK resident is able to enjoy the benefit of the value transferred. The arrangements are either motivated by a tax advantage or there is a tax mismatch. Now, the tax mismatch shows that you are paying less than 80% of the tax that you would have paid if there hadn't been this arrangement. Now, obviously, with tax rates rising in April, more companies will fall within, and more businesses will fall within this profit fragmentation rules. Okay, why don't we do the third poll? Okay, answers. Ooh. Interesting spread there of answers on that basis. Clearly, for those, thank you very much, for those who are looking at a Labour majority or a hung parliament, you could have a situation where taxes rise this year, fall again just before the election, and if there's a Labour majority government or a hung parliament, rise again, but with different rises after the election. We are obviously just over 2 years from when an election has to be called, and I think the election has to be by January 2025. It can be called in December 2024, but has to be done by January 2025. So if we're in the 2-year period, we do need to obviously think about what other parties would do if they became in charge of the nation's finances. Okay, raising finance. So just a couple of brief points on that. SEIS, they're doubling the limit on that. It's a 2-year window. It's for companies with a small capital base and a small amount of investment, less than 25 full-time employees. Money must be used within 3 years. The limit doubling to £200,000 per annum. In terms of that, you get 50% relief on your taxes. So let's say you spend 100,000 on SEIS, you get £50,000 knocked off your taxes. You can also reduce your CGT rate by 50% as well. And once you've held the assets for 2 years, potentially they qualify for business property relief as well from inheritance tax. And if you lose money on the shares, then if there are unquoted trading companies, you can claim the loss net of any SIS relief. So there's no double claim against your income tax liabilities. So again, particularly useful. In terms of the reliefs, a company can raise money under the SEIS scheme, the Seed Enterprise Investment Scheme, and then under the EIS venture capital regime, but cannot raise under EIS, BCT, and then SEIS. Needs to raise under SEIS first, and therefore making that regime more attractive means that more people would want to consider that. There are some shareholder restrictions in terms of SEIS relief being withdrawn if the individual is entitled to more than 30% of the ordinary share capital of the company or its subsidiary company, or the issued share capital of the company or subsidiary company. You have to watch for the voting power in the company's subsidiary company and the assets eligible for distribution to equity holders on a winding up. Generally speaking, there are a significant number of requirements in terms of SEIS, but it's one of those areas where there is, obviously, as tax rates go up, there are real potential advantages in doing SEIS. The issue that I think you have is that there are a raft of rules. I don't have time to go through them all. There are a raft of rules which mean that investment can only be made in quite limited circumstances. But what you will see between now and the end of the tax year is a lot of promotion of companies which are trying to obtain SEIS funds. In terms of what you're trying to do, you're trying to raise funds for business activities. You have to spend the money raised. There can be no pre-arranged exit for the shares, and they need to be qualifying arrangements. There needs to be trading, carrying on a qualifying business activity, a UK company or permanent establishment, not part of a partnership. In terms of comparing the reliefs, what I'm looking at here is income tax relief at 30% for EIS, Enterprise Investment Scheme, which is the big scheme for larger companies, and they can be up to 12 years old. Whereas SEIS, Seed Enterprise Investment Scheme, is for really small companies, where the relief is potentially up to £200,000 from 2023, or rather you can put in £200,000, and income tax relief at 50%. Both of them get IHT relief on shares after 2 years. And you can carry back the contributions and set them against the prior year tax liability. Note it is the tax liability, not the taxable income. So it doesn't help you if you're in the 60% bracket by reducing your taxable income. You can't do that. The only way you can do that is through pension contributions, charitable deductions, deferring income, or accelerating expenses. In terms of capital gains tax, you can roll the capital gain you have into an EIS scheme, which defers capital gains tax. But if you believe in the next few years capital gains tax rates will go up, certainly that's what the Labour Party is proposing, then rolling it into a deferral vehicle may not be a good long-term solution, something to think about. Whereas in terms of SEIS, you can claim relief at 50% against the CGT element. So why are the reliefs bigger for SEIS than EIS? Well, I always look at the chances of survival and think of the difference between EIS is a growing company, a bit like a pot plant. SEIS is, as the name suggests, a seed, and therefore on that basis, if it is a seed, seeds have a lower percentage rate of success, which is why they're generally cheaper to buy. One final element to mention on that is knowledge-intensive companies, where the costs of research and development or innovation are at least 15% of the company's operating costs in at least one of the 3 previous years, or at least 10% of the company's operating costs in each of the 3 previous years, and which has created or is creating or intends to create intellectual property, which has employees with relevant master's or higher degree who comprise at least 1/5 of the workforce. This is to encourage, sort of really the sort of offshoots from universities and research and knowledge intensive companies. And there you can double up the EIS relief. You can get another £1 million per person invested into knowledge intensive companies, and they can be up to 20 years old. It's an area which I think will be exploited more in the near future. I was going to look at IR35, but because the rules have changed back to, or rather have not changed at all, but remain with the end user, that is probably, sort of, it's the same as it was from April 2021 for private companies, and the same as it was since April 2017 for public, public bodies. They are the end user on that basis. So in the last 5 minutes, I just want to look very briefly at the proposal for separating spouses, in terms of what are we looking at for separating spouses, what are the FB 2023 proposals here. And there are a number of proposals on that basis. So there's a dormant asset scheme, the ability for tax not to have to be paid unless the individual claims the monies. But the one I really want to look at here is the transfers between separating spouses. Civil partners be given up to 3 years to make no gain, no loss transfers of assets for capital gains tax purposes. What are we looking at here? Well, the current rules are When one spouse leaves the matrimonial home, the property ceases to be the departing spouse's main residence for CGT purposes. This will in turn create periods of absence on an eventual sale, with PPR restricted accordingly. The final 9 months of ownership will remain eligible for relief, but the period between moving out and 9 months before the disposal will not. So you've got the deemed 9 months period. There is currently scope under section 225B for the departing spouse to continue to treat his or her absence from the property as a period of deemed occupation, provided the property continues to be the only or main residence of the former spouse and the departing spouse does not have another property which qualifies for PPR. And that is typically the case where the departing spouse moves in with friends, family, or into rented accommodation. What the changes propose is changes to the inter-spouse transfer rules, which will affect inter-spouse disposals made on or after the 6th of April 2023. What you're going to allow is, instead of only the disposals in the year of separation being on a nil gain, nil loss basis, you get the following 3 years. So up to the 5th of April, following the 3rd year of the date on which the anniversary of which the couple separate, which effectively means you get the 3-year extension plus the year in which you separate as well. And that means that if the couple separated on, say, the 16th of August 2022, any inter-spouse transfers made between the 16th of August 2022 and the 5th of April 2026 will take place at a nil gain, nil loss basis. Before that, they would have had to make disposals by the 5th of April 2023. There has now been a 3-year extension on that basis. Or if they actually get divorced, then the extension falls away at the point that they get divorced. One of the important differences is that couples who separated before the 6th of April 2022 and did not transfer their assets before the end of the tax year, their separation, will now need to wait until the 6th of April 2023 to make any tax-free transfers. So if the couple separated before the 6th of April 2022 and were looking to make a transfer, say, this month, it may be a good idea to wait until April 2023, 6th of April 2023, to make that transfer. But as I critically point, whether it is practical or desirable for them to wait a further year or to make any transfers depends on their personal situation. But obviously, conversations will need to be had. One of the difficulties with this is the result used to be, or under the current rules, would be very much that the donor paid tax on the transfer of the asset after the year of separation. They would end up with the CGT charge. If we're transferring on a nil gain, nil loss basis, then it'll be the donee that ends up, the person receiving the property, that ends up with the eventual CGT charge when he or she sells the property. So that does have some issues to it. Let me take a very quickly through an example and then we are pretty much finished. So Richard and Liz married in June 2016, moved into a house that they bought jointly for £200,000. Separate in June 2024, and Richard moved into a flat he'd owned before the marriage, which had been let in the meantime. He did not elect for the family home to continue to be his only or main residence. He decided that he wanted from the word go, when he moved back in, that the flat would start to acquire PPR. June 2026, Richard and Liz were divorced, and as part of the divorce settlement, Richard transferred his 50% interest in the family home to Liz on the condition that Richard would be entitled to 50% of the eventual proceeds of disposal. So the house was worth £400,000 in June 2026 and was sold in June 2028 for £500,000. So from Richard's point of view, it ceased to qualify as a residence in June 2024. Richard's disposal of his 50% interest in the house in June 2026 takes place at no gain, no loss, being a transfer on divorce after April 2023. Liz therefore acquires her additional 50% relief at Richard's original base cost, giving her a 100% interest in the house with a base cost of £200,000. In 2028, Richard receives future consideration of £500,000 at 50%. So £250,000 was his right to the share of the house when it was sold. This gain will qualify for the same principal private residence relief as he would have done at the time of the disposal of the 50% interest in June 2026. The PPR up to June 2026 is Richard's period of actual occupation when he actually occupied the property with Liz. So June 2016 to June 2024 being 8 years, plus the final 9 months, giving 105 months out of a total period of 120 months. If the rules remain the same, the gain on the right of sale would be $250,000. Take off the PPR, which is allowed, which is the 105 months, which is the actual occupation of 96 months, plus the 9 months deemed occupation that you're allowed for the last 9 months of any residence that you've ever occupied as your main residence. You apportion that over the 250,000, that's 218,750, leaving a chargeable gain of 31,250. For the other property Richard has, he could elect for it to be a PPR. And in terms of Liz's position, Liz will make a gain of 50,000, being 50% of the £500,000 sales proceeds, less her CGT base cost of £200,000. That will, because she's always lived in the property, that would be fully covered by PPR. So action points where couples are separating, you do need to explain to them the potential changes in the rules, what is going to happen come April 2023, and whether they need to take advantage of the new rules. At that point, many thanks indeed. I hope that was of interest to you. It's brought to you through Tolly's, but I've left there my email address, and if you want to look at my company website. Otherwise, thank you very much indeed, and I look forward to seeing you at the next CPD event, which is in early December, after we've had yet another fiscal or budgetary statement. Thank you very much indeed.